everyone, and welcome to Money Mondays. My name is Natasha, and I'm the Community Integration Specialist here at the Trenton MFRC. Today on Money Mondays, we're going to be talking about compound interest and also how to tackle your debt. And today our expert on this subject is Denise, who works with SISIP as a financial counselor. Thanks so much for joining us today.
Thank you, Natasha. It's a great pleasure to be here. And tackling debt is probably one of the top priorities of probably a lot of Canadians, and of course the military community as well. So yeah, we're going to talk a little bit about compound interest and how to tackle that debt.
Okay, perfect. So I guess we can maybe start with, what does compound interest actually mean?
Yeah, so the very simple way to put it, one-liner, compound interest is interest on top of interest. So it can work great for you if you're saving. So when you're saving your money, you're earning interest on the money that you put in, and then you're going to earn interest on top of that interest. So if you're saving your money, that can grow pretty fast over time. However, if you're carrying debt, interest can be a detriment to your financial goals, because now you're paying someone else that interest on top of interest.
Sure. And then the other question I have is, what are some strategies that can be implemented to help pay off debt?
Yeah, and again, that's another big question that people propose to me on a daily basis. And the number one rule with getting debt paid is going to be a very hard thing to do, but the number one rule is to stop using credit. So the credit cards, typically, they have to be put away. You have to pretend that you don't have them. They have to be locked up in a safe or put it on an ice junk in the freezer, delink it from all of your apps on your phone, but you're literally, if you want to get the debt paid down, you have to stop using it. That means, in order to do that, you have to have a very strong budget. And please read or watch our budgeting video, because it will tell you how to establish a budget. But you need to have a really strong budget. You need to be saving every month for regular expenses, such as Christmas, car repairs, clothing, gifts throughout the year, birthday parties, emergency fund. So that's really important. And you do need to have an emergency fund as well. Really important. You don't want all that hard work of paying your debt down, and then have to use it for Christmas and defeat that whole purpose. So that's rule number one. That's top, right? That's the very first thing. Number two is to set a realistic debt reduction plan per month. So let's just say, for instance, you have established your budget and you know that you think you can afford $500 per month on your budget. Make sure that that's realistic. So I'll often have people who are throwing large chunks of money on their credit card, but then they're going back out and using it because they didn't budget enough in their budget for gas or groceries or eating out or activities for the children and that kind of thing. So if you're going to set an amount each month to pay your debt down, make sure that it's realistic so it doesn't jeopardize the rest of your goals. Number three is use the snowball effect, which again has been a technique that's been used for many, many years. And all that means is, do you know what I mean by snowball effect? Sort of?
A little bit, yeah. Maybe if you could explain it a bit more.
So what that means is, once you have one debt paid off, whatever that amount you were putting on that debt has to now go to the next debt. That money is not to be used for something else. So that's called the snowball effect. So you're committing to a set amount for a specific period of time to get your debt paid. So that's the snowball effect. Number four, maybe you do need to consult with your bank or your financial institution to consolidate all of your debts. So if you do have 3 credit cards, 2 credit cards, maybe a credit card and a line of credit, perhaps you need to amalgamate them all into one. Typically, that will put you into a lower interest rate than perhaps your credit cards, which ultimately will help you save money. And then you'll have one payment, not 2, 3, 4 payments, because that can be very overwhelming.
Hard to manage, yeah, for sure.
Yeah. Hard to have a good budget as well if you've got 3 or 4 different credit cards that you're trying to pay. So that could be another option to tackle your debt. If you're going through your budget and you're noticing that it's really tight, perhaps there's an opportunity to increase your income. It could be a side hustle, or it could be another member of the family who's going to maybe start contributing if they're not already, or increase their income. So increasing your income, and of course, reducing your expenses. If you comb through your bank statements, which we do suggest in our budgeting format, is if you go through your bank statements, you could potentially find a minimum of extra $50 by cutting a little bit here and there, and that can have a big impact on debt reduction. So even just looking through your bank statements and see what you can cut, and see if you can find that extra money to put towards your debt, can make all the difference in the world. And number 6, set realistic goals, which I kind of alluded to. I often have people trying to pay off debt in a short period of time that's just not realistic, and it just sets them up for failure. So make sure that you do have realistic goals, that you're not trying to pay off $20,000 of debt in 6 months.
Right.
Typically, that's not going to work. If it hasn't worked all along, it's generally just not going to work. So when we say stop using credit, and I'll often get this, that means 100% stop using it, right? It does not mean that you are going along great with your debt reduction plan and you decide, oh, I'm just going to make my gas purchase on my credit card for $100, and I'm going to go home and I'm going to pay that $100 on my credit card. So it negated it out. Unfortunately, because you're paying compound interest, because you're paying interest on top of interest on your credit card, that will not work. So it literally means not using it at all.
Yes.
Yeah. Another technique that I see a lot of people trying to do is they will get paid and they'll put their whole paycheck on their credit card. So then what happens? They're using their credit card again. So it's just never going down.
Yeah,
So those techniques will not work. So that's what we mean when we say put the credit card away. Really important.
Yeah, it really sounds like probably the most important one, right?
Absolutely.
Yeah,
Yeah.
for sure. Last question we have for you. What are the different costs associated with borrowing, and what are the different types of borrowing?
Okay. So I'll go with the different types of borrowing and then maybe lead into the second part, the first part of that question. There are tons of types of borrowing out there. I'll go over the main ones that you see. So you have a credit card, which probably everyone knows what a credit card is. That's a form of borrowing. You have overdraft protection on your bank account, which is another form of borrowing. A line of credit, which is a revolving form of borrowing. You have mortgages, student loans, car loans, buy now, pay later. You see those all around town, the Brick and Leon's and Mechanics. Buy it now and you pay it later. Private lenders, could be a family member, payday loans, which are a very high form of borrowing. So those are the different types of borrowing, and the costs associated with it vary. So you'll have some of them that are high interest rates and some of them that are lower interest rates. Some of them will have fees attached to them, some of them won't. So for instance, I'll talk about credit cards specifically because that's the one that probably everyone is quite familiar with. Your credit card, there's advantages and disadvantages to both, to having a credit card. Having a credit card, if you pay your balance off by the due date, you pay no interest, right? So you'll have a 21-day grace period to pay your bill in full. As soon as you don't do that, you're now into a interest rate bracket, and it's compounding. So interest is getting compounded on top of interest, and the interest rates on that are about 23.99% today. So that can have a drastic effect on your financial goals if you're not paying it off in full each month. Credit cards as well will have different fees if you were to take cash from them, and that's going to be more expensive. If you tend to go over your limit on your credit card, you're then going to be charged an over-limit fee of $29. Sometimes credit cards will offer you different insurance products that's very costly, and that's going to have a cost associated with it. So that's fees, interest rates on credit cards. When it comes to borrowing money, you want to try to find the lowest form of borrowing possible, because it's not realistic to say that we're not going to borrow money. I mean, I don't know of very many people who just buy a house without getting a mortgage. Sure, that could happen, but typically we're getting a mortgage, right? That's going to be your lowest form of borrowing is your mortgage. Keeping in mind that the bank has a lien and has a collateral on that home, right? So that's going to be your lowest. And then you're going to look at lines of credits, which would be your next lowest form of borrowing. And a line of credit is sort of like a credit card, but you don't get the 21-day grace period with a line of credit. As soon as you start using a line of credit, you pay interest immediately. Okay? And then from there, there's going to be a whole bunch of other ones that are going to hit into the higher interest rates. Overdraft protection is like 24%. Payday loans is like 49%. So those are the ones you want to try to stay away from. Okay? So you need to borrow money for an extended period of time, like perhaps you're doing some home renovations that could be costly, you're not going to get it all, you don't have $20,000, then look to your line of credit as the option. You do need to have a very good credit background, credit history to qualify. You do need to have positive working situations, so good employment history. So those are the very important to keep in mind. But really pay attention to your statements so that you understand what's being charged on all of these different borrowing products.
That's all some really good information. Thanks so much for sharing with us, and we'll see you next week.